Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
So I thought for today's conversation, I thought it would be a good way to go through and sort of summarize a lot of the things that we've seen now, given that it's quarter end. It's been, obviously a very busy first 3 months of the year. And the view we had at the beginning of the year coming in that we were going to be in a low interest rate world for longer, I think in some ways has just been even further confirmed. But maybe walk through some of that outlook and then what you've seen really the last couple of months.
Yeah, I think even what we're here today just to talk about specifically, on this Friday, what's happening and what are we doing about it. But it still requires some context in terms of how quickly we got here and how much has changed in it's not even the last month, it's the last 3 weeks, which has been extraordinary. So really saying that the battle that we were fighting was that we've come from a market that was at all-time highs, where the U.S. Federal Reserve and the central banking system had injected just an incredible amount of money into the system, and interest rates were incredibly low, and valuations were high. So we were getting in a position, and we had been in a position for several months of trying to get as defensive as we could, and then you got hit with the, basically shutting down. We're now at the point of shutting down the planet. We're shutting down continents, and it's not just a recession where recession is 10% of the economy will slow down or 20%, where you're just taking the consumer out.
Totally offline.
Yeah.
Yeah.
And so and understanding that. And so really all the issues that we were dealing with before, and I think this is really our main message, is that the way that this problem of the virus and the economy being shut down is being an incredible injection of money into the banking system and in the economy actually makes the previous problem that we were dealing with even worse.
Yeah, I think the other thing that's happened too is really in the last 3 weeks, the latter half of March, is given that you now move to a point where you're shutting down the world economy for an extended period of time to try and fight the virus, you then have this sudden flight to cash across all assets. So what happens is the correlation or the relationship between all kinds of different asset classes spikes higher. And basically what it means is that everyone is trying to rush to the exits to get their cash as quickly as possible. And when you have stress on the financial system like you do, the cash that people run to first is the US dollar.
Oh, and just explain that exactly, just even so from an individual can understand that of sort of saying, well, I'm dealing with my mother who's older and she's got to make sure she's got money to pay the woman that comes in and helps her with food and cleaning. But that's just in a microcosm. And then you said that how that affects businesses and having people really understand that when you're running for cash, like the scale of this problem.
Yeah, I think the important thing to keep in mind is really in a global economy, both on a trade front and a capital markets front, the flow of capital all over the world, I think, has been really magnified the last decade. Absolutely. And so what's happened is you have a record amount of US dollar denominated debt that is offshore. So in other parts of the world, I think the number that we've looked at is somewhere between 13 and 15 trillion. And so if you're a company in Asia or in Africa or South America, you predominantly probably have at least half, if not more than that in your sort of your capital structure in US dollar based debt.
Oh, just put that in context of and then the US debt, just always comparing the numbers.
So 13 somewhere between 13 and 15 trillion with a T internationally is borrowed in US dollars. And so what happens is you shut down big parts of the global economy, which means that a lot of companies and businesses and even governments for that matter, revenue goes to zero, but the debt doesn't go to zero, and you still have this. So you have this funding problem in the very short term, and so you have this rush to say, oh, I need to make sure I have enough US dollars for the next 6 months, so I can pay my debt, so I can pay my rent, so I can pay my employees, and so it's a sudden rush to cash very quickly. And so what was interesting is really in the midst of the storm in March, you saw stocks getting hit, but bonds got hit too. There was a lot of liquidation in bonds, both government and corporate. Other asset classes like commodities or gold were also being sold. And it was really just saying, I I don't care what my longer term view is. I just need cash over the next 3 months to make sure I can keep the lights on with my government or my business or my global company. So you had that initial rush into the dollar that put that upward pressure on it. The central bank in the U.S., the Federal Reserve, then tried to decrease some of that pressure with some of these swap lines. So basically it means they swap currencies with other global central banks, and you try to flood the system with US dollars to alleviate some of that pressure. But the problem is it doesn't fix the bigger issue that a lot of the revenues for these companies have gone to zero. So you can lend dollars to another central bank, but if a company in Asia has revenue that just went to zero, how are they going to be able to pay their debt? So you're in the midst of this cash shortage in the system as long as the economy remains shut down.
So right now, as we said, we've seen the incredible 3-week panic, and we've sort of put in a low that was on the 23rd of March. And we see this incredible policy response. We can talk a little bit about that in a minute. And it sort of feels like there's a breather. But as I said, the work you've been doing and showing us is that there's still this other whole part of the world that needs dollars in their hands, and that might not have happened yet.
Yeah, I think, and we talked about this a little bit earlier in the week, is saying there's actually some great reporting on this, both on the Wall Street Journal side and Financial Times, starting to highlight a lot of the international countries, I guess you'd say developing countries that were really starting to have debt problems, and really that need for dollars. But I think a lot of this comes back to how long is the economy going to remain shut down. And I think that there's, the initial thought was this is maybe 2 weeks to a month. We're now almost 3 weeks into this, so we probably are at least another month. And then there's even, scenarios where it goes longer than that. And I think that these debt issues become much more prominent the longer that this lasts. And so I think there's the immediate desire to get the health situation under control, but a lot of the economy globally needs to get back to work, or else these issues are going to remain now for the next several months. I think in a lot of our meetings and communicating with clients, our view still is similar and hasn't changed, that the longer term pressure on the US dollar is going to be much lower, but you're now in this very short term period where there's a rush to fund your liabilities that are based in US dollars, and so you're getting a little bit of a push higher. But I mean, one of the charts that we like to look at in the office in our meetings is just the relationship between the budget deficit in the US and trade deficit combined, and overlay that with the US dollar with a 6 month to a year lag. And you have, you mentioned the stimulus package at $2 trillion for this one. I think the Federal Reserve now is going to lend up to $6 trillion. I think the Federal Reserve balance sheet increased by almost $1.5 trillion in the last 3 weeks. So this, huge levels of fiscal spending in the U.S., but they were already running a 5% of GDP deficit. It's going to 15 really easily. It might even go to 20. And so our view on that basis is still the longer term pressure on the dollar, US dollar, is going to be lower, but you're in middle of this storm right now where until these funding issues get settled, there's still going to be some of this pressure in the system.
Yeah, so if I even try and frame that and just put it, in my mind, I'm always trying to simplify things. So I think it clearly is that we were in a world a month ago where I've got my stock investments, I've got my bond investments, and then really what I need right now is I need cash in my pocket. And specifically, as you've just pointed out, is the world uses the US dollar. And so we can even say, well, what's the strength of the Canadian economy we're in? It's kind of irrelevant. The US dollar gets stronger because we were sort of thinking that this originally, if you're going to flood the system with money, but it's the dollar is even, the need for dollars overwhelms that in the short term.
Yeah.
So first I have to sell my bonds, but there was a week or so ago, there was nobody to sell the bond to. So the central bank has to come in to buy the bond so that you can get dollars in your pocket.
Yeah.
And also if you have stocks, it doesn't matter. A lot of times it's just you have an investment that, great, I was owning this for the long term. Oh, but I actually need the money now.
Right.
And so the money comes from being invested in bonds and stocks. It whooshes into the US dollar. And again, as we say, we don't think that's over yet.
Right.
And this is really what we're watching, and we'll come and talk about this in a minute, which is that at least so much trading has gone on and we've put sort of levels on these things. But going forward, once everybody has this money and it gets distributed, it solves that problem. But the central bank is doing its damnedest right now to actually devalue the dollar to get themselves out of it. And we're right back where we started this conversation, which is saying that why we want to own hard assets, dependable businesses, essential businesses. So the money goes sweeping into the US dollar, but at some point the money has to come back into the stock market and buy hard assets, because there's a big potential that the dollar could be devalued over time.
Yeah, I think the amazing thing is sitting here watching this, talking about it, thinking about it every day, is really just the speed and the ferocity of how quickly this is all coming together. And so, we put a lot of thought into where our view was at the beginning of the year and how we're going to prepare for what this outlook is going to be now for, our view always is a much longer term view of saying, what do the next, 2 to 5 years look like and how do we want to invest around that? But then you have these very short term intermittent periods where, kind of it's just storm and all these clouds are brewing and everything, breaks loose. And it's just saying the long-term view and outlook hasn't changed. It's just, you're right in the middle of the storm. And I think the unique nature about this was that everything got sold in, those particular bad days.
Talk about gold then specifically. So we own gold because we think we want to own a hard asset. We think this devaluation is finally this thing that is probably coming around. But in the last 2 weeks, just run through how did gold actually behave as a defensive strategy?
Yeah. So, the amazing thing is that right up to the end of February, gold actually was outperforming almost everything, maybe other than some parts of the longer term bonds that had done well for the first 2 months of the year, but gold had done really well. And then all of a sudden you got into the first 2 weeks of March where everything got sold. So everything got liquidated from both, gold in the futures market, or the price that you look at on the screen. Gold miners got sold, the gold ETFs got blown out, which then created other liquidity issues. So I think the other problem too that happened, and it was very clear a couple of those days where it was just mass liquidation of everything, is we've moved into such a financialized world and there's just so much money sloshing around that then, a lot of bigger market participants will take their positions and lever them 2, 3, 4, 5x. And so that works when the market's moving in your favor. But as soon as that train stops, you instantly have to de-risk. And it doesn't matter what you're selling. It just says instantly that these computerized trading programs are set up to just de-risk everything. And it doesn't even matter. The what's going to happen in 6 months or a year or 2 years doesn't matter. It's just what's going to happen in the next 6 hours.
Right. How to get
just sell everything.
So another way of saying is this big move to cash. Actually, another way is it explained in stock market terms is the largest margin call in history.
Right.
And with interest rates being so low, which means you can borrow money so cheaply. I'll throw your at 2 times X means I bought a Canadian gold company and I borrowed money because it didn't cost me any money to own it because it was absolutely going up until this cash thing happened, which means I need cash more than I need my gold stock.
Right.
Gold stocks just collapsed along with everything else. But when they went up, it was just stunning to watch how fast they recovered.
Oh, they just totally, And I think you could
2 days or 3 days.
You could always feel the margin call because it's just indiscriminate selling, pause, and then you instantly bounce back to where it was before. And I think to your earlier point, I was just saying, we've now set a couple of different ranges in the market where the initial forced liquidation, margin selling, panic low. There was a low put in about a week and a half ago. It rallied off that low pretty hard, both in Canada and the US. And now we've kind of set a range of, which is probably going to be a tradable range going forward. And then going back to what the outlook looks on the health side going forward, but maybe talk about that from a perspective of what we see over the next couple of months in terms of what the market may or may not do.
So I think one of our big takeaways today, make sure we hit our conclusion, is that we think we're in much better shape than we were, much better shape in the portfolio for where we think the world is going to be going forward. Mm-hmm. And we've had a number of transitions, and everything, all our conversations and our research in the last 3 weeks has been around transitioning the portfolio as fast as you can to sort of what are these essential businesses in the economy. I think the conclusion is you can make the immediate assumption saying, well, this wouldn't be a great time to own a cruise ship.
Right.
That's the simple conclusion. But the other one is really, if this goes longer, and we'll still make sure we touch base on this, is the length of time of this, because that is the unknown. Everybody's saying that started out with an impression this might be a 2-3 weeks, but this is longer, in which case, as it gets longer, it's just the consumer is where the problem is. And so we're making sure we're transitioning the portfolio into much more essential businesses. And you always think about Bell Telephone. Going through 2008, 2009, we just watched how Bell Telephone's business actually grew. Mm-hmm. So there are certain businesses that we can own that just don't get shut down in this. Actually, they just, nobody can function without them.
Right.
And so transitioning the portfolio into those sort of things, but we still own businesses. We just don't, in our strategy, or trusting us with your money, we still own things, and we just don't run that. It's that run to US dollars and run back is something we don't do. We can, at the margin, we can protect, but really we have to find these businesses that are going to do well in the next 1, 2 to 3 years.
And you had done, we had a meeting this morning, but you'd done a lot of work on just putting a certain percentage number on what you would consider to be essential businesses within what we're doing outside of our cash and our goal position. And was it almost 65%?
Oh, sorry, there's 30. Sorry, I will do that. So the note, our quarterly report, which is going to come out shortly, and it'll be on the website as well. And so that sort of shows that there's almost 2/3 of what we own, which is in cash, gold, bonds, and mortgages, and then these essential businesses. And so, and really, when we're talking about the stock market, and we're sweating it every minute, every day, but it's really a much smaller percentage of the portfolio that we're talking about in that. And the essential businesses, what we're talking about, is said like Bell is an easy one, but things like CP Rail, nothing gets around without it. We've got it, so it's the guts of the economy, the transportation, the essential businesses, and these are not being shut down. As opposed to, it's really hard to understand what the consumer, where you're going to be when you come back from this. It's just such an unprecedented event to shut everything down.
Yeah, I think the other side on that respect is now with what the market has done the last couple of weeks. I think the difficult part is that there's always a longer term view of our view, and how we approach it is, as business owners, we like to invest in long-term businesses, things that we think can protect and grow capital over long periods of time. But then there's also, you get into this short-term period where the market, everyone thinks about is what are the technicals saying, and how much have you retraced of that previous low. And because the most difficult part right now is, I think, and this is why our view is that it's so important to own a huge proportion of the portfolio in these essential businesses, because to try and take a fundamental view or try to predict what earnings are going to be like over the next year, or I would even say close to the next 2 years, is going to be really, really difficult. So then a lot of these shorter term technicals and ranges become more important, at least from a kind of ring fences where the market's likely to trade. And so maybe talk to that a little bit about this idea of, we put in a low a couple of weeks ago now, and that there's likely still to be another test of that, and then what the outlook might be for the next few months on beyond that.
Okay, I'll set that up by touching on the first point, which is really what we've been doing here is that you're trying to analyze your business normally, saying, okay, how profitable can it be? Is there any growth? Now it's actually completely flipped on its head. You still read the newspaper during the day, but you're not making investment decisions off the newspaper. You're making investment decisions off solvency.
Right.
So we're going through all our companies and saying, okay, actually a number of them are net cash. You hear your lines of credit. You have all of our businesses have been great about getting that information out to us. And then the question is, do we think our dividends are safe? Because really what we're hoping to do is we're still collecting our dividends, and we're able to keep investing our way through this. And instead we've got a strong portfolio, and we just keep picking away as we go patiently. And we'll talk about the levels, because that's exactly what your question is, and about today's call. But really there's no way to know if this goes longer, is your dividend safe? Because a company might just say, oh, it's better for me to have that money in my pocket than it is to dividend it. But you also know your company is stronger because it's made that decision. But so far, other than a couple companies that we're watching closely, we actually think that most of our dividends, we should be able to get through this. And really from the length, we've touched on the length of time, but the stock market always looks out 6 to 9 months. So everything we're doing today is looking into the fall. And the stock market looks into the fall, and that's the hardest part about investing, is you can just be incredibly uncertain about today, but the stock market is always judging how the fall is going to be. But the problem is how much business goes on in the fall really depends how deep we go And then can we get back to work? Can the consumer get back? Can all the people in the hospitality industry, pay their rent and, get back to work?
Right.
So that sets up the context. So then specifically talking about today, so that was the long-winded setup for
that's
it.
good.
So we've had that incredible steep, severe pullback. And depending on the market you look at, I mean, the simplest way, the Dow Jones Industrial Average was at 30,000 and it fell just below 20,000. So it was down a third. What we found was almost everything across the board. If it was a financial asset, it went down about a third. And then we've had a recovery since then. So now what's really important about this is we've now set that bottom on the, a week and a half ago. We have that low point in the market. Then we had sort of a relief rally, which came to a technical resistance line. You're not telling anybody this. Everybody's looking at the same point, point on the chart.
Yeah.
You've rallied to that, so now you have a rebound rally and a high, and you've got a low from a week and a half ago, and we're just sort of trading in that band. And probably whether we think this is going to go longer. So right now we actually don't have to do anything. We have to watch and see how this resolves itself.
Right.
If we gradually break up and everybody hates the market and it's over and the market can see through the fall, or if we fall to a new low, then we're going to have to be more patient and sit on our hands. And again, we've got 12 to 13% cash and we've got our list of things we're waiting for to buy. And this is our playbook. We've got the market set up that's going to tell us what we're going to do going forward. We know the things we're looking at, and we're patiently going to go through. So I would say the next time we have this conversation, we're going to know where did we test those 2 points.
There's more clarity. Yeah, more there will, for certain. It's amazing how much is happening and how much news flow and how much market action 2 weeks will tell you. And I think the other thing adding on to that is that one of the things that's really blown out the last couple of weeks is the volatility index, so the VIX, which examines the level of panic in the market
I'll give you my. I want you to talk about the VIX because you've done all the work in this, but I'll tell you having followed this is. It measures the amount of volatility in the stock market, and we'd actually gone from a period of incredibly low volatility. But I saw this definition years ago, so if I just share this, it's great. In 30 days' time, what is the probability that 30 days will be the same as today?
Right.
And so the amazing thing is we spent 3 years of most days, a month from now is going to be the same as today, like almost the same.
Yeah.
There was no volatility in the market. And then you have almost zero probability that a month from now is going to be the same.
Yeah.
So you go from it's a unit of volatility of 10, and we had it almost as high as it's ever been, which sort of it ramps up to around 80 or 90.
Yeah, so that's exactly the point. Is when you look at the volatility index and how high we had got in the middle of March up to 85-90, which is really just an incredible level to be up there and to be sustained. But now that we're starting to put in lower highs, there's a little bit of a calming effect going on instead of being at that panic level, but still with the volatility index at 45, it's still an incredibly high level. And I think the one chart that we looked at earlier this week that I thought was really interesting is if you put up how the volatility index looked in 2008, 2009, it peaked in November of 08, but the market didn't bottom until March of 09. And so I think in our playbook for what we expect over the next couple of months is the best thing would be to see the market try to make a new low, whether it fails or not, as long as it's kind of within that range of where it bottomed, but then to see that happen with a much lower volatility index, then I think confirms that you've wiped a lot of that anxiety out of the market. And then at least you've put in another sort of tradable bottom, which are probably going to have a pretty significant bounce on at least into the fall. I think and totally agree with you that the outlook beyond there is still a little bit uncertain with how deep this recession is going to be and how quick people can get back to work. But at least it gives a bit of a framework for making decisions of saying, there's a technical way to look at what are really good buying opportunities, but also still having our list of companies that we're looking at and saying, okay, this is the day we've been waiting for, the week, and now it's just a matter of saying, what are we going to buy here at this level?
Okay, I just want to make sure we touch on these two other key points, and really since we did this last podcast and we wrote about it in a note that went out to clients, but really we've now had an extraordinary stimulus. And so this is the first time we would talk about it. So again, the problem is that we know we're in this contraction. We know the economy is incredibly shut down. And usually you will wait for the government to react, except it looks like the government has fully reacted over and above anything that has ever happened before.
Yeah.
So again, the problem is when we look at the fall, you've doubled your stimulus. So you were just this afternoon putting numbers together, and I just to say for you to put it in context for people, the size of the U.S. debt.
Oh yeah.
And then the size of what the deficit was, now what we think it's going to be, and what is the size of the debt coming out of this, and then in Canada is sort of a mirror of what's happening in the U.S.
Yeah. So I think on the way we thought about this, and Matt and I talked about this on a podcast about a month and a half ago, of the U.S. At the end of 2019. The simple numbers are the U.S. economy is about $21 trillion in size, and they were already running a deficit of around $1 trillion. So deficit to GDP in the U.S. in December was about 5%, which is just that number one divided by 2021. And so the package that we saw from Congress 2 weeks ago is $2 trillion. But in a recession, what happens is government revenue also collapses. And you have unemployment go up and all these things, and unemployment insurance and stabilizers kick in. So just the simple way to take it is the $1 trillion, which was the run rate from before, add $2 trillion. I would even say generously add another $500 billion. Is probably going to be another trillion on top of that, with how low revenue is going to come down. And so you're very quickly at $3.5 trillion or $4 trillion just this year in net new borrowing in the U.S., which is at $4 trillion, that's 20% of GDP, which is just a staggering number. It's a number that you see in emerging markets or really, impoverished developing countries where they've got some kind of a corrupt government and they're just spending like crazy. And so the U.S. is now faced with this situation of saying, how do we get ourselves out of it? Well, of course the government's going to respond, but the level of stimulus being thrown at this is so significant. And I think so coming out of this, the national debt in the U.S. is going to be somewhere around 27 trillion by the end of this year, and your economy is probably still going to be around, say, 20 or 21 trillion, because on a full year basis you'll contract a bit, and the numbers just start to spiral out of control from here. And I think that this is actually the most difficult thing about the period of time we're in, is where you have this 1 or 2 months where everyone wants to rush to cash because they just need it to get through the next 6 months. But then you have a government that's going to issue trillions of dollars of debt and spending, and not even talking about what the Federal Reserve is doing. And so through this period, currencies and just dollars will hold in well. But then in a few months to a year, probably the last thing you want to own is paper money, because governments are going to do everything they can to inflate it away. And it's the most difficult thing about the period we're in, is that the government spending numbers just start to get so out of control. And at what point do you lose faith in the ability to, for that money to maintain purchasing power? And the governments are going to desperately try to create inflation, or the central banks are. And I just think it's definitely, a very complicated mix looking out a year or 2 years from here.
Yeah, absolutely. How hard, just how extraordinary this time is, and how, the world is not going to look the same going forward.
Yeah.
We keep on saying that some things will be the same and some things are consistent, but just you can't get that genie back in the bottle, to use that term.
Yeah.
And really, we've had discussions over the last couple of days of inflation, and just even inflation in the near term, what that looks like. And I think just share a couple of those ideas, because it might not, again, it's such an extreme inflation that people, it really helped me to visualize what might be different about it.
Yeah, I think, the easy thing, it's actually not that hard to create inflation. The government can just say, wire $10,000 to everyone's bank account tomorrow, or $1 million, or there's no amount of money that will impact it. And I think in the US they're doing what they we would call helicopter money, basically mailing checks out to people, and that, that's good for the next month or two to get you through. But now everyone says everyone's going to expect a check from the government every couple months, and it's just the mental effect, or the psychological effect that this has on people's behavior going forward, I think is going to be significant. But to that point, it's not that hard for a central bank or a government to create inflation. But once you you do that, it's incredibly hard to slow it down. But at the same time, you can't just create growth overnight. So if we're moving into an environment where you create inflation and there's no growth, it's actually the worst environment out of all, which is stagflation, and where you cost.
But even just walk through, just so you've got money in your pocket, you're going to the store, but the problem is there's just nothing. There's only a few things in the store.
Like there's a shortage of it becomes a shortage of goods. Like you can create as much money as you want, paper money or people's bank accounts, but there's a fixed amount of goods, and you have supply chains breaking down, and you have all these issues now getting goods across the world, and so there's a shortage of everything. And so what happens when you create more money is that everything gets more expensive.
Yeah, in shutting down the economy, this is an extraordinary thing, and we talk, having been a base commodity investor for most of my career. Yeah, the extraordinary situation we're in now, which I've never seen before, and why you might get positive on the commodities is because you've shut down all the mines, and it looks like now oil is in very much its own universe, and that's a whole other day going into that. But just in terms of copper, uranium, or you're talking even about gold, you're shutting down all the mines, but there's a need for the actual product, and you've created all this money so that the money chases the products that have already been created, but people aren't in business
creating
supplying
new ones.
it.
Yeah.
So it's this short-term inflation that we have never seen in our in our generation.
Yeah, I think a lot of that comes down to still the biggest question out there is, how quickly can the health situation get under control, and how quickly can people get back to work, and how structurally are you changing people's psychology and behavior once they go back to work? And I think that there's this short-term period, like we keep reiterating, that there's a rush to cash, but then cash is probably the last thing you want to own in that kind of inflationary or stagflationary environment, because the purchasing power of currency gets eroded very quickly.
So let's just conclude on that then. So what are we still envision that we're in it now. Yeah. This rush to cash. We believe that you still have to come back to the stock market, and as I said, the businesses that we're trying to invest in now for where the world is going to be in 6 months and 2 years from now.
Yeah, and I think the idea too is still, we got dividends coming in all the time every month. We have still, like you said, 12-13% cash positions in the accounts, and to be buying things through this, I think there's another couple weeks to a couple months where the market chops around. You probably put in a low, and then you probably bounce significantly higher into the fall. But there's still this outlook, looking forward and saying, well, with interest rates going to be low, if you're going to have more inflation, you want to own gold. You absolutely want to own real estate. I mean, we're very, very light right now on the commodity side, but there's an argument to be made. You actually want to be, more into commodities in that kind of environment. We're not quite there yet, but I still think these essential businesses, so utilities, infrastructure companies that we own, all of them still are vital in that kind of a period of time. But it'll be fascinating to see how we move through these next 3 months. And I guess we're now at the end of the quarter, so we'll have a quarterly report out in the next couple of weeks, and then look forward to the next conversation from there.
Yeah, and I'd say that's most of our business is hard asset type investing, and that we like doing tangible businesses. Bricks and mortar is sort of the way it historically sorted. But again, maybe we'll touch on this because this will be for another podcast. Really, the way that the economy is evolving is that, especially going through this, an essential business is your health insurance. Right. An essential business is your software provider, not your product, not your consumer. Your consumer technology device. It's much more that the systems that we have to run our business are actually becoming essential. We can shut an awful lot of our business down, but there's some things that we just cannot shut down.
Yeah, and it's the same for most businesses, that your critical software and infrastructure aren't going to get shut down. And so really the focus remains trying to find these certain parts of the economy that we think will actually become even more crucial through this period and bouncing out of it.
There we go. Lots to talk about next time.
Okay, and look forward to it.
Okay. Yeah.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, Google, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.